There are many different strategies which could consider for hedging, and I suppose it just depends if worried about a short-term market correction or a more serious long-term turndown. If simply more worried about general direction, then instead of hedging out the entire portfolio by selling it, using some of these CDS indices can be a pretty efficient and useful way to put on a hedge. And the nice thing about that is liquidity is not too bad, so at the point you don't want it anymore, you can just sell out of it. And generally liquidity should be far better than the bonds themselves. So that's one way. Other ways that we see people addressing such a similar concern is to look at some sort of tail risk hedging, whether that be buying cheap out of the money equity put options, again with the rationale being that correlation between equities and bonds should become very high in a crisis, and generally that can be an efficient way. Other people choose to look at out of the money FX options instead because FX volatility is generally lower, so these options can be cheaper. And further, some prefer to use quantitative strategies, which generally are indicator based, and what they claim to do is to be able to have some measure of some indicator which hopes to predict future market movements. And as such, if they do what they're intended to do, these strategies then can deliver the performance in terms of market crisis. So we see all of those approaches used by investors.